Hey everyone, hope you're having a great day. The Federal Reserve just met, and there are some important takeaways that we need to talk about. So, I have my notes here on the highlights that I believe are the most important to you and to our financial future, so let's discuss them. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's talk about the meeting today. So, first and foremost, right off the bat, rates were not raised. Now, there was a general consensus that this was going to be the case, so that is not out of the ordinary. What is interesting is that peak rates are projected to peak at anywhere from 5.5%, which is what we're at currently, to 5.75%, which is a quarter point higher than we are currently, which means that there is still room left in the tank for another rate increase or two, potentially by the end of the year. We are still in a high interest rate environment, and we're going to remain as such for quite some time. The other major piece is that the general consensus is that rates will only fall by 0.5%, not the full percent that was expected in 2024. So the low at the end of 2024 is projected to be a federal funds rate of 5.1%, which is still very much elevated. Remember, we are accustomed to near zero rates for the last decade. So this is a quite elevated rate. Another thing that is important to note is that rates are not seen to fall or are not projected to fall below 3.9% until the end of 2025. That is a full 2 years away where we are seeing a 3.9% or higher federal interest rate. That means for the foreseeable future, for the next 2 years, which in economic terms is a long time, we're going to operate in a high interest rate environment. That means that mortgage rates, car loans, credit card loans, etc., are going to remain higher than usual or higher than we are accustomed to for a longer period of time. 3.9% in 2025. That's 2 years away. 3.9% is almost double the rate that we are accustomed to for the last 10 years, because usually the federal funds rate has hovered at 2% or below for basically a decade. Now, with that said, there is some good news for the general economy. Federal projections project a stronger economic growth for 2023 at around 2.1% for the year, as opposed to the previous 0.4%, which would have been considered weak growth. Now, that is good because that means that even in a higher interest rate environment, the Fed is projecting a soft landing. Remember, a soft landing means getting inflation under control while avoiding a major recession. So strong economic growth in the face of high interest rates is a good sign. But it also means that the Fed has breathing room to increase rates higher. So remember, it is a good thing because we want strong economic growth, but it also signals to the Fed that there is room to either hold interest rates high or increase them higher, which they might need to do because they don't believe that inflation will reach the target rate. Remember, the Fed has a target rate of around 2%. 2% means the economy is doing what it's supposed to do, at least in regards to inflation. They don't believe that we will reach that inflation target rate until 2026, which is a lot further away than most people were projecting. So that means end of 2023, 2024, and 2025, we will not be at the target rate of 2%, which means we will be feeling the effects of inflation more than we normally do on a year-to-year basis for the foreseeable future, which means that inflation is still here and the fight for inflation is still here, which is why the previous things that we've just mentioned are important. The Fed is going to keep interest rates high to fight inflation for longer than expected. Now, unemployment. This is a number that has been good for the last year or so. Unemployment is hovering at around 3.8% currently, and it is expected to peak by the end of the year at 4.1%. So an increase in unemployment. Why? Well, because of the high interest rate environment. Remember, high interest rates help defeat inflation, but they also cause economic slowdown. So while it looks like we are avoiding a major recession and there will be a soft landing, this is also signaling to the Fed that their policies are working and that the economy is starting to lean on the brakes. Okay, it's not falling off a cliff, but it is leaning on the brakes, and unemployment is starting to rise because of interest rates being high. So what does this all mean for you? Well, for one, any sort of loan mortgage or otherwise, is going to remain elevated. Now, we also need to talk about stocks and the bond market. Of course, higher interest rates is usually good for the bond market. And of course, the 2-year Treasury note is up on the news at the highest it's been since 2007. Why? Because high interest rates, good for bonds. Now, stocks did fall a little bit. Here's the thing. I have a lot of experience in the stock market. I've been monitoring the stock market for over a decade, and I've been investing my own money for basically the same amount of time. I love stocks, and I love following them. These are my thoughts. Anytime interest rates are high, you're going to put pressure on the stock market because the stock market is comprised of companies which require funding to operate. When interest rates are higher, that funding is more expensive, which does cause economic shrinkage. On top of that, when interest rates are high, bonds are more lucrative for the average person. So there is more money that is put into bonds than otherwise usual, which again puts pressure on the stock market because either A, you're not getting an influx of money into the stock market, or B, people are removing money from the stock market and moving it over to bonds because it is currently more lucrative than usual. So people who are risk adverse tend to move money. So you have slight pressure on the stock market. With that said, the stock market and the economic growth go hand in hand. So if we can avoid a major recession and we continue to chug along economically, I don't believe that the stock market is going to crash next year, and I do believe that we will continue to see near highs or higher highs throughout the next year, even in the face of higher interest rates. And as interest rates come down, that should only benefit stocks further. So all in all, to summarize this most recent Fed meeting, rates stayed the same, but rates are also most likely to increase slightly, and rates are going to stay elevated through 2024 and into 2025. So we are operating in a high interest rate environment, and we will continue to do so. Inflation seems to be coming down and going into the right direction, but it is not over yet, and it is not near the target rate of 2%, and the projections are that inflation will not be at the target rate for a significant amount of time, for at least 2 years. So what does that mean for you and me? To summarize, higher interest rates for longer, and we are going to feel inflation for a longer period of time. On top of that, remember I've made previous videos about the real estate market and the crisis in affordability in the real estate market that we are feeling. As long as interest rates remain high, there's going to be pressure, upward pressure, not downward pressure. There's going to be upward pressure on real estate prices because there are less houses on the market, because builders cannot build, and people with 3% and lower mortgages do not want to sell, so there is an undersupply. And until we get interest rate down to a place where builders can start building and be profitable, as well as that section of the market come online and onto the sales market, we're going to have upward pressure on the market. Now, of course, as interest rates come down, more people can afford more house. So if interest rates start to come down in 2024 and 2025, but there is still not a building supply increasing, then we will have upward pressure in the real estate market because more people will be able to afford more house. More people will be qualified for more house. So we need interest rates to come down, but we also need housing shortages to go down, and we need housing supply to go up. There is a housing shortage. When you look at the data, there is a housing shortage. I read a very, very interesting article, very well written on this data. So if you want me to forward you that article, send me a message on Instagram. My name on Instagram is Derek Polishek. Send me a message on there. It's the verified account. Send me a message on there, and I will forward you this article. It breaks down what's going on in real estate very, 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 very well. And I think anyone who's interested in that should give it a read. But other than that, this was an update on the federal meeting that took place today. Remember, we have 2 more Fed meetings. We have one on November 1st and then one on December 13th. So there is still time for the Fed to raise rates this year. As always, my name is Derek, and I got my degree in finance, so you don't have to. I love this stuff. I love economics. I love the stock market. I love finance, and I love personal finance, and I love sharing that with you guys. So if you enjoy that stuff, you're in the right place. Please consider subscribing if you haven't already. It helps the channel tremendously. And please make sure to turn on the bell notification so you don't miss the next video. I usually do videos every single Tuesday, but sometimes, like today, when things of importance come out, I'll release a second video. Actually, I believe this video is taking place on Wednesday. Yeah, so I've released a video already twice this week because there are certain things that just need to be covered, and this is one of those things. So if you want to stay abreast on what's going on economically, you're in the right place. I love you guys, and I will see you next week for our scheduled programming. Take care.